Hello, everyone. My name is Austin Hageman, a principal advisor at the firm, and I'm joined by our Chief Investment Officer, Henry Mercer. Today, we're going to walk through some of the slides from our quarterly market update deck. The charts we'll cover today highlight key data points that our investment committees consider when making decisions, giving you a bit of a look at what goes on behind the curtain. So, before we dive in, a quick 30 seconds background on the wealth management side of the firm. Withum Wealth is an independent registered investment advisor providing investment management and wealth planning for high net worth and ultra high net worth individuals and institutions. We're structured as a true fiduciary, which means we don't sell products, we don't earn commissions, or get paid to push any particular investment. Plain and simple, our clients pay us for quality, honest advice and investment implementation, and that's the only compensation we receive. Our team has institutional level access across both public and private markets, giving clients a broad, objective investment universe. We also have relationships with multiple private banks and other providers in the industry, so we aren't offering a confined set of resources. Our clients have access to resources that extend beyond one company. By the way, if you like these kinds of conversations, check out our podcast, Amplified Wealth. There's a QR code on the screen right here in front of us now. It will bring up our website, which links to all the various ways you can follow and listen into our podcast, Amplified Wealth. We bring on some very big names in investing. A fair amount of them you might recognize from shows like CNBC and Fox News. We cover all kinds of timely topics with new episodes dropping at least once a month. You can find Amplified Wealth again on YouTube, Spotify, Apple Podcasts, Amazon Music, pretty much anywhere you listen. Just search Amplified Wealth and hit follow so you'll get an update when a new episode comes out. All right, with that said, let's jump into the markets. So, bubble talk seems to be everywhere. So, let's start there. So, on the screen here, on the left chart, that gray skyline we see rising up on that left side, that's CapEx, which is just another way of saying capital expenditures. This is the money the big five hyperscalers are pouring into AI. So think Alphabet, Amazon AWS, Meta, Microsoft, and Oracle. The numbers ramp up hard, as you can see. Certain projections are calling for $350 billion in AI spending for 2025. That's up over 50% from last year, which was already up huge from the previous year. That's the most capital intensive build out we've seen in the digital economy since the telecom boom. All this spending pays for the physical stuff behind AI. So think of data centers, chips, custom silicone, networking, and power. And if we swing to the right-hand side, now we're seeing industrial production, how much real stuff the US is actually making. Since the CHIPS Act in August of 2022 and the public launch of ChatGPT later that year, production in semiconductors, computers, and communications gear has taken off and is outpacing the rest of the economy. So bottom line, to summarize these two charts, the AI build out keeps compounding. The open question now is whether every dollar of investment earns its keep, or whether we are in a bubble and some of this becomes overcapacity that benefits the long-term prospects of technological development more than the first movers that investors are flooding money into right now. What do you think, Henry? Are we in an AI bubble?
Boy, Austin, that's a loaded question. What I would say is that we're seeing something that's historic. It really is unprecedented in the scale of this. The dollars being thrown at it, the growth of capital expenditures being spent, the sort of limited nature of the companies participating, the so-called hyperscalers. I didn't at the beginning of the year even know what a hyperscaler was. Now it's like, it's all over the place.
Right.
So, I mean, there are certain characteristics of a bubble, sort of the scale of it and the way the money is being spent, but it's perhaps too early, in my opinion. I think there could be, or it could be not necessarily maybe let's call it the fifth inning of that one at this point.
Sure. Yeah, to your point, there are similarities and then there are big differences. You know, I would argue at this point in time, The AI expansion does look sturdier than the tech boom, right? When I think back on recent bubbles, the tech boom obviously comes to mind. I'm sure it comes to a lot of people's mind. And when you look at today versus then, what you see is balance sheets today are not what they were in 1999. Today's build out is really funded predominantly by cash and robust margins. So these are profitable hyperscalers. These are profitable large companies. Back in the tech bubble, vendor financing loops were a key failure point. Sure, we are seeing capital expenditure loops where one company is giving money to another, that's giving money to another, that's giving money to the original company that let off that loop. But this spending isn't being funded by massive amounts of debt like it was in the 90s. Sure, there is some debt involved, but we're not seeing that rise in debt like we were back in the 90s. So I think that in particular is a very underappreciated difference between now and then. You think about some other areas, monetization for AI is already happening. So cloud demand, coding productivity, ads, enterprise AI tools, they're all generating revenue right now. So it's not a build first and monetize later strategy like we saw during the technology bubble. We're also seeing high utilization right now. Back in the tech bubble, companies were laying miles on miles of fiber optic wire, and they ended up overbuilding. At the dot-com peak, less than 10% of that fiber that was laid down was actually being used. Okay, today's data center utilization associated with AI is roughly 80%, and vacancies are less than 2%. So supply is the bottleneck here at this point in time, not demand. So again, this isn't necessarily a build it and they'll come story like back in the tech bubble. The story is looking more like today, at least. They're already here, and how do we build to catch up?
I mean, the difference between now and then is back then, the companies involved in the 2000 tech bubble, they were small, speculative, basically business plans written up on napkins. The participants today are the world's most powerful companies.
Right.
You're seeing the most of the members of the Mag Seven, the stocks that have been participating the most in the current stock market rally, caught up in this wave of spending. And if there is a concern, it's that they have perhaps lost some of their historical discipline in terms of their capital allocation. That these companies have been benefiting from their asset-light business models. They have used capital, I would say, quite intelligently in terms of how they invested in their business, but they didn't require a lot of money to operate the business. So they threw off tremendous amounts of free cash flow, which they can distribute via stock buybacks, dividends, or just research and development. But it was a very, very efficient business model. They seem to have gotten away from that. They've been fortunate enough that they do have enough free cash to spend now without borrowing money. But down the road, this could change sort of the basic business model of these companies. It's like they want to get to the finish line first, and they're willing to do almost anything it takes to get there.
Right. It's a race, and it's almost like the competition that they have between each other is driving them to kind of step out a little bit further out on that cliff. With the hopes that AI pays off and they're going to earn their investment back because and they're going to do better than the next guy because they did the extra building, right? It's kind of like this self-fulfilling or this push that they're all kind of pushing each other towards.
I mean, when the Mag Seven were younger companies, particularly Meta Platform, for example, they were able to sort of take advantage of various technology busts or times when the IPO market was sluggish to buy really great companies. You could make the case at a value price. And it just, the whole behavior here is different. We've talked about in Austin that it's the CEOs who have kind of got swept up into this.
Right. They're like they're like celebrities now. I saw an article this is a while ago, but Jensen Huang from NVIDIA is signing somebody's chest at some sort of event. They are. They're acting like celebrities, and I guess we do have to be careful of what that ego boost it may result in.
I mean, part of it is today that companies become so associated with their CEOs. Perhaps historically there's probably nothing like this. So they are celebrities, and it's all part of the marketing of their business. It revolves around them, where they're the stars. And yes, in certain cases with NVIDIA, the product's the star also. But it's a very strange environment.
It is. It is. And, I know I mentioned some reasons that now is different than the tech bubble buildup, and why that should potentially give us some ease. But there's still some reason to be, cautious. Uh, you have return on investment and depreciation risk. So hardware cycles are fast. Asset lives and resale values may be overassumed right now. So what do I mean by that? So just take a step back there. AI hardware is moving very fast. Those fancy H100 chips that NVIDIA has that's powering AI right now cost tens of thousands of dollars each. But that next chip called Blackwell, that's already coming out, and it's way faster and more efficient than the H100 chips, like ridiculously faster and more efficient. So if you just built out a massive data center full of the old H100 chips, you might have originally expected when building it out that you'd make your money back over, let's say, 5 years. But now everyone wants the new Blackwell chips, and you're only 2 years into your investment. So the old stuff, yeah, it still works and it works great, but it's just isn't worth as much anymore. And so you aren't getting that value you thought you would have had out of the data center. And that's the risk, right? Technology is improving so fast that some of these expensive projects could lose their earnings potential before they've even paid for themselves. You also have things like power and permitting, sorry. Power is a huge challenge right now. These data centers use a ton of electricity, and the grid in a lot of places just isn't ready for it. So even if companies have the land and the chips, they might have to wait for power hookups or pay more money to get them to where they need to be, which can hurt profitability by adding to costs and or delaying profits. And then lastly, valuations are high. And we'll talk about that a little bit later, but private market AI valuations have surged. Just because an investment might be productive for an economy doesn't mean the price you pay won't be too high to ever get a meaningful investment return out of it. That's not to say that these won't get you a return, but valuation risk needs to be considered.
That's an excellent point, Austin. There's a big difference between perhaps the economic aspect of this and the investment aspect of it. These companies, the ones that particularly the most well-known hyperscalers, they've all had their own niche in a sense, their own competitive advantage, and they built moats around certain aspects of their business. Now they're all competing against each other,
Right.
and it's going to be hard to figure out which one builds the moat around it. And it may be just something that they're not used to experiencing. And the fact that they're throwing money at it like this could be a sign that they're afraid.
Right. And it's not unusual for there to be a huge build out when there's a new technology emerge, a huge build out, then a period of consolidation, and then the companies that emerge from that period of consolidation aren't necessarily the ones that spent all the money getting that new technology out to roost. It's the ones that end up being able to use the technology best and perhaps take advantage of an overbuild out. For example, like what happened during the technology bubble build up and burst.
I mean, Amazon's a classic example of that. That their stock price fell like 90% post bubble, but they had the business and they had the leadership and the business model, and they prospered. And it'd be very interesting if there is any kind of shakeout. That could be where some real opportunities are. But right now, it's a very narrow field.
Mhm. Yeah. So quick plug, if anybody's interested in the AI build out or just getting more in the nitty gritty of AI from the investment perspective or even from the use case perspective, we do have a podcast episode on this where we interview an investment expert from the field and a consultant who works explicitly in AI. So if you're interested, the episode's titled "The AI Boom: Investing, Innovation, and Everyday Applications" on the Amplified Wealth podcast. But let's move on to valuations. So as we know, all that development we spoke about, the chips, the data centers, the excitement around AI, it's not just an economic story, it's also a market story. And investors have been chasing it hard. And when people get excited, prices move faster than profits, and that's where valuations come in. On the slide I have up now, we see how far those valuations have stretched compared to history. When you look at it, we're actually approaching tech bubble style valuations. So you look at it here where we are now versus where we were during the tech bubble, build up, right? The valuations do look very similar. So how do you think about valuations relative to earnings potential of the markets right now, Henry?
Well, of all the sort of basic stock market indicators, valuation in the short term is perhaps the least effective way of analyzing things, and this chart certainly shows that. I mean, right now the S&P 500 is trading 24 times forward earnings, which is right up there with 2000. The valuation right now is it's like at a 40% premium to the average P multiple over the last 20 years. The information technology sector is like at a 60% premium to average historical value. So you're experiencing something that it might be sort of a danger indicator, but the market can stay overvalued here for a prolonged period of time. The fact that we've gone to these levels of valuation, you hate to say this time is different, but there could be some aspects behind it that are different. Below the surface, there are a lot of very attractive, reasonably priced companies, but the high multiple is related to the most well-known, the Mag 7s, et cetera, that have really built out big multiples. A risk might be that with the spending on hyperscalers, that the estimates for future earnings growth for the hyperscalers has come down quite significantly. The forecast. I mean, there's still positive earnings, but it's at a much lower growth rate than we've experienced already. So there is that background risk. But right here, yes, the market is very richly priced, but that doesn't necessarily mean that it's a threat like the bull market's going to end, because there's just too many things under the surface that can keep this thing going.
Right. I completely understand why a retail investor may look at a chart like this and fear kind of overwhelm them of, wow, look at where we are, look at what happens when valuations get this high. However, to your point, we do need to look under the hood. And so I think that's a good jumping off point for our next slide here. So valuation, as you mentioned, is just one part of the story. Looking at valuation is kind of like assessing somebody after the first date. It's all interesting top layer stuff, but you need to see what's under the surface before you can make a real judgment. So here on the slide, we're looking at the S&P 500's profit margin in orange and its PE ratio in blue. What we can see is that valuations as measured by the PE ratio tend to follow profit margins over time. So when corporate profit margins widen, that is, businesses are better at creating bottom line profits. That's what widening profit margins mean. Investors are generally willing to pay more for each dollar of earnings. So PEs rise. And when margins compress sharply, valuations tend to come down and stocks look cheaper on a PE basis. So back to what you were saying before, Henry, do you think this provides any justification for why investors might be willing to pay up for stocks right now and pay for those higher valuations?
Oh, most definitely, because the best businesses tend to have high margins, and the strength of margins in the last 2 to 3 years has really been outstanding. and it does support higher PE multiples. Also, with the Fed lowering interest rates or in an easing cycle, lower rates support higher multiples. That's why in the background, what happens to interest rates here is also very, very important.
Right. And and I would understand, right? And I think that makes practical sense that if I invest in a company that's going to earn more profits for every dollar it takes in, I would be willing to pay more for that company than a company that earns less in profits for every dollar they bring in, right? That just makes that's intuitive. That's intuitive sense.
It's totally right. And if you look at history, the best performing stocks and the best businesses over time, they do trade at high multiples. They trade at often a multiple above the market average. So what we're seeing here that you can justify the valuation in a sense that these the strength of the business behind this is legitimate,
Right.
and the fundamentals are there, and that's a really powerful thing happening there.
Mhm. And so, just to bring this back, because I mentioned the tech bubble to kick us off here, and we don't show it here on this slide, but in the 5 years before the tech bubble burst, profit margins were hovering in the single digits and only widened about 1% or 2 leading up to the bursting of the bubble. In today's environment, we're seeing aggregate corporate profit margins almost twice that amount at 13.5%, with margins widening, with margins that have widened by roughly 4% in the last 5 years. So we are seeing that, we are seeing that margin widening, and it's doing so to a much greater extent than what happened back during the tech bubble.
I mean, the stock market is demanding, and I would say at this moment in time that you cannot run a business in the United States that's publicly traded and get away with sort of shoddy business metrics. You're forced into efficiency, and technology is enabling businesses to operate with higher margins. And I would say this is kind of where the AI comes in, that we don't know societally what it'll mean for jobs, but it certainly will increase productivity business wise. And it should be very, very positive for margins. I mean, you're seeing it all over the place that companies are laying off workers. Amazon 30,000 workers announced 2 weeks ago because of AI and things they can do. Those are it's the administrative level that they're cutting out.
Right.
So it's good for margins. It may not be great for society, but that's what's going on here.
Right. And when you think of the P ratio, I think a common misconception is I feel that people tend to look at the earnings part of the ratio, as almost a fixed variable, right? When it's not. The P and the E move independently of each other, and you could think of a P ratio as a rubber band with 2 points. Price is on one side and earnings is on the other. So as one side falls behind the other, and that rubber band loosens and then stretches again, that's how we start to see those high valuations and low valuations. And what you find is as that P ratio stretches, that rubber band stretches, and let's say price is leading off here with earnings trailing behind, you can have one of two things happen. You can have that price snapback, right? Or you can have price start to slow down in terms of its growth rate while earnings catches up. And that's what investors are betting on right now in buying into these high valuation investments, is that earnings will catch up to price. You look at some companies like Nvidia, with when it took that recent surge, even after its huge price increase, its PE ratio is actually still pretty good because its earnings were projected to increase by even more, right? And you look at, closer to today, this year, we've seen some of the large tech companies have earnings grow quicker than their price. So I wouldn't say that all this means that we should count on this continuing with extreme certainty, the earnings catching up to price. But we also shouldn't count on prices falling precipitously over the short term with extreme certainty either. We have to intelligently weigh the possibility of both these outcomes, when we look at a PE that looks rich relative to history.
Right now, companies have been growing into their multiple, and it's a powerful thing, and most likely, if the market is to correct, it would probably come from somewhere else at this point, not necessarily business activity, because there doesn't appear to be any immediate threat of horizon. I know we're of a immediate threat of a recession of horizon, but I know we're not getting any economic data out of out of Washington D.C. these days. But the business seems to be doing pretty well, and so I wouldn't at this point let valuation scare me.
Right. So up to this point, we've talked about the financial aspect. Valuations are high, profits are also strong. But here's something I find interesting on this slide. If we were really in an AI bubble, you'd expect people to feel euphoric, right? That's what we saw back in the tech bubble buildup. So back around here. Oh, and by the way, what we're looking at is when this line trends up, this is consumer sentiment. That means that those that were interviewed for this, those investors are feeling more optimistic when that line is moving up about the next 12 months in the economy. When the line is moving down, that is suggesting that investors are more pessimistic about what's going to happen over the next 12 months of the economy. So, in periods like the tech bubble buildup, people were getting more and more optimistic. You were seeing that euphoria shown through in this consumer sentiment report. Then, when the bubble burst, they became more pessimistic, right? And that's something that you often see. Generally, when people are very optimistic, future 12 months returns are actually lower than average. On average, since this chart's data points here, there have been 10 sentiment peaks where people were very optimistic and then that deflated. Average return after those times was around 4%. Okay. When people are feeling more pessimistic or the most pessimistic about the next 12 months of the economy, what happens is returns actually tend to be much higher than average. Over this data sample, returns averaged about 24% over the next 12 months when people were very pessimistic. So when we look at where we are now with consumer sentiment at lows, we're actually not even near the lows after the bubble burst. We're closer to the lows after the financial crisis. That to me is interesting. Isn't that something? Do you find that interesting, Henry?
Oh, I certainly do. I mean, this is consumer sentiment used to be quite a reliable contrary indicator that low consumer sentiment often led to great stock market buying opportunities. And if you look at the chart, go back to 2008, December of 2011, most recently back in June 2022, just great times to buy stocks, and consumer sentiment was in the tank. And now we're like consumer sentiment's in the tank and we're at record highs in the stock market. And I know we talked about it, Austin, but it's really very difficult to figure out what's going here. I kind of think a lot of it has to do with just the general political environment in the country that we're so dysfunctional, and the lack of bipartisanship and us against them from both parties, and social media just has people feeling lousy about things. Yet the stock market is the best indicator of what's really going on with the basic economy. But the mood of the people is obviously they're very depressed.
Right, right. So we've looked at profit margins, which are strong, elevated valuations, which cause some worry. We also looked at sentiment, which is still very cautious, which actually is a good contrarian indicator, historically at least. The natural question is, what do we do with this information? So this next chart helps answer that. It shows that when valuations are high, like they are today, future long-term returns, meaning rolling 10-year returns, tend to be lower than average. So there's a bunch of dots here. So this is just plotting different times over history at different valuation points and then matching it with the 10-year coinciding return. So what we're pinpointing here with the triangle on the left and the triangle on the right, the triangle on the right is the S&P 500, the traditional market cap weighted S&P 500 index, where the largest companies have the most influence. The second triangle here on the left, this is an equal weighted version where every company counts the same in the S&P 500. So the big names don't dominate the data points. Right now, as you can see here, the traditional S&P 500 is trading around a 23 forward PE. So when we go back and look at the return side of this chart, historically, what this is showing us is that the average 10-year return that has followed valuations at this level have been in the low single digits. But when we look at an equal weighted S&P 500 index with valuations that are currently closer to 17 and a half times earnings, the story changes a bit. That same historical comparison points to average 10-year returns around 7%, so approaching the high single digits. And the market in general, depending on which decade you're looking at, tends to earn you anywhere between 8 to 12% on average. So that gets you more towards average forward-looking returns. What do you think this says about the opportunity set, Henry?
Well, this is where sort of the long-term power of valuation comes in. That when you reach these levels, that the basic message is prudent investing requires that you lower your expectations a bit. You just can't expect the market to perform the way it has in recent years. But doesn't say it's not going to happen, but you shouldn't expect it. That it does, wonderful. But this is where Withum Wealth's focus on maintaining a diversified asset allocation comes into play, because that's where it really kind of proves its value in markets where, let's say, if the equities trade lower for a period of time, well, you're going to be diversified by perhaps market cap, all sorts of ways. If you're value oriented, certain stocks are going to outperform the market. But that diversification should prove very effective in generating a long-term return and not totally relying on the equity market to, be the locomotive to power the train.
Right. And it's important to keep in mind that this is only looking at 10-year rolling time periods. Historically, PE ratios have been, to your point before, a terrible predictor of short-term returns. In fact, they've only explained about 20% of what happens over the next 12 months. So they tell you almost nothing about how the market might behave in the near term or even over the next few years for that matter. But when we stretch that out to a decade, the relationship gets a lot stronger. Over 10-year rolling periods, valuations have explained roughly 70% of the variation in future returns. That's meaningful. And it tells that valuations tend to point to, but not predict, long-term return trends. And still, I'll throw on another caveat there. That leaves, if it predicts 70% of the variation, that leaves 30% of the time where markets did whatever they wanted, right? And anyone who's ever been to Vegas knows you can still win big when the odds aren't in your favor. So yes, valuations help set expectations, but they don't write the script. And what this is telling us to expect is if you're going to overweight in the names that are currently highly overweighted in the S&P 500, then you might want to adjust your return expectations down a bit. It's not to say they can't outperform other names or they won't continue to lead the pack, but from a historical sense, from a valuation risk sense, it may make sense to broaden your opportunity set, both from a risk standpoint in potentially avoiding any price declines out of those larger names. And then also increasing the opportunity set in terms of your ability to capture return, right? What valuations are telling us, and valuations is one metric of many, is that those other names, those names that aren't as represented by the typical market cap weighted S&P 500, their future expected returns are looking a bit rosier than the market as a whole.
People have to remember that stock market returns are lumpy. They bounce up and down. It's, let's say we're expecting 8% for the next decade or something like that. Well, it's not going to be 8%, 8%, 8%. They bounce around. And part of the allocation strategy is that we're trying to put clients in a position when the markets are more difficult to boost their equity allocation at times where the odds are so in your favor that you're really setting the table for the long term. But honestly, for investors today, a period of stock market weakness would enhance their ability to generate above average long-term returns if you're a true long-term investor. So volatility is our friend, and it should be expected and not feared.
Right. 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 As investment advisors, we are managers of risk. So, in order to win in the stock market, I think it's prudent to stay disciplined to an approach that makes sense for you, that looks to embrace risk as opposed to run from it. If you're constantly running from risk, you're going to be missing out on some of the best opportunities the market has to offer. At least historically, that has been the case. When you try to run away from the declines and try to time the market. Now, I'll also say that what we're saying here is this isn't a game of get in the market, get out of the market. Now is a good time to get out of the market. There is plenty of information that still states that if you're taking on equity level risk, you should expect to be rewarded more than someone taking on, cash type risk or fixed income type risk, right? That may not always play out over short time periods, but over the long run, that is still a very fair expectation, in my view and in the researcher's view. Also, we're only looking at the S&P 500 here. You look at markets overseas, international is up over 30% this year, right? Valuations do look more attractive over there. They don't have the tailwind from, having some of the largest technology companies in the world, but it also doesn't take very long to grow one of those. You look at something like Nvidia, which is a U.S. company, or a U.S. based company. That went from nowhere in the top 10 of the global stock market to one of the top names in the global. I think it's actually weighted number one right now in the global stock market in just over a 5-year period. So it doesn't take long for a company like that to emerge. And the way I look at it is AI is not a technology story, a technology sector only story. AI is a much broader story. If AI is actually going to work and these technologies are actually going to benefit from these investments they're making, you're going to need consumer staples and industrial type companies, companies from all different types of sectors. They need to be willing to buy into the AI, to bring the AI into their company. And if they're spending $1 to bring AI into their company in some fashion, they're going to need to expect to receive in return more than $1 worth of additional revenue for that or additional profit, right? You're not just going to invest in AI in hopes that it leads to nothing. So theoretically speaking, what should happen is we should see derivative effects of what we've seen, and that AI growth should start to spread throughout the whole market. Then we would likely see competition cause prices to come back down, right? And that's the beauty of capitalism and the way our markets work. But this isn't just a technology sector story. This is a global company story.
And there are opportunities. I mean, I just read this incredible stat the other day that NVIDIA reached a $5 trillion market capitalization last week. NVIDIA's market cap is larger than the entire S&P 500's consumer staple sector. All those companies combined do not equal an NVIDIA. So that's Coca-Cola, Procter & Gamble, Colgate, Clorox, all these great consistent businesses. It just shows that they're extremes. And if you're diversified within the equity market, as we do at Withum by sector and with a really serious fundamental look at all the companies, analyzing benchmarks, ratings, all sorts of stuff, we're going to be exposed to areas at all times where there's opportunity. And you can make the case today that there is a lot of opportunity within the equity market. that, let's say, might outperform the average return over the next decade.
Right. Right. So I think, just to kind of close out the AI bubble talk, we need to respect the profit margins of these large companies that are leading the market right now. We also need to respect where valuations are, and we need to weigh that. And then we also need to respect the opportunity set that exists beyond them. So I think it's not about ignoring one or the other. It's about taking all this information in, weighting it properly, and moving forward with something that makes sense for you.
Mm-hmm.
So speaking of bubbles, and we don't have a slide for this, so let me move to something less. We don't need to look at this statistic, statistic dot plot here. So don't worry about this slide. I'll just leave it on this one for now. But we've talked about how sentiment towards stocks has been cautious, yet prices remain high. In contrast, when you look at something like gold, everyone seems to love it again, right? Prices have surged. Headlines are calling it a new era for gold. Gold euphoria seems to be creeping in, which is opposite of what we were seeing in consumer sentiment. That's, to me, when it's worth asking the same question we just did about stocks, right? Are fundamentals really driving this surge up in gold price, or is emotion starting to take the wheel? What do you think, Henry? Are we looking at a gold bubble?
Well, I'd hate to call it a bubble, but because bubbles can go, they can blow up more than you think is possible. But I do think that perhaps the gold rally initially was kind of triggered by certain fundamental factors, whether it be kind of worried about tariffs and where the U.S. was headed, certain the weaker dollar, all sorts of things like that. Central banks uh, purchasing gold. There's certain aspects of that, but it seems like animal spirits. It's become a momentum story, and that is certainly what bubbles are all about. It's about price momentum, not fundamentals. And I'm not a gold analyst, but I'm an analyst of investor psychology. And I mean, there's nothing to say how high gold could go, although it has pulled back over the last couple of weeks pretty aggressively. But it's not the kind of asset that I would want to necessarily buy on a dip. But as I said, it could go. But for me, it's like I don't really have any view on what the future trend might be. I know what it might possibly be, but it's not the kind of thing that I personally would place a bet on.
Right. And I would agree with that, especially at these levels. I think you have to know what you own, right? If you're going to be an owner of gold. I've seen research that suggests that if you keep a strict percentage in gold, right, and you keep rebalancing that year after year after year, that it can offer benefits to a portfolio as a whole. Um, but there is a lot of speculation there, and there isn't any earnings power coming from gold. It's not like when you buy a stock of a company after it's dipped in price massively, or you look to buy, the Mag 7 right now, even though valuations are really high, right? We could justify that by the potential earnings we can get from that, right? With gold, you're not getting any dividend yield or any type of earnings from that. And you can't discount that is a highly speculative market. So I wouldn't be in the game of trying to guess where prices are going to go next. I think, at that point, you might as well take your money to Vegas or Atlantic City.
As the old story goes, they don't ring the bell for you to get in, and they don't ring the bell for you to get out. I've watched gold for years and years, and it does have these moments where it has spectacular bull markets, and everybody thinks this time is different, and it fades over time. My first year in the business, I can remember that this was back in the late 1970s and 1980, and gold was going through the roof, as was silver. And in 1980, the Hunt brothers went bust trying to corner the silver market, and gold went into a prolonged bear market. So you just never know. It's not like you invest in a great company for the long term. You bought Coca-Cola 20 years ago. That's one thing. But buying gold and projecting, you don't have anything. You can't do any kind of cash flow analysis at all to base evaluation on. So it's a speculative animal, and we're we're fiduciaries. It's not kind of the field that we would certainly play in any way that would sort of compromise what we're trying to do for clients long term.
Right. Right. And you're getting something that has stock like volatility. And if you're looking at rolling 10-year periods over long periods of time, it tends to earn a little bit less than the stock market or appreciate in value a little bit less than the stock market. So, you're getting something that's just as volatile, may earn the same, may earn a little bit less than stocks. But even so, to me, I'd rather have something that actually has, earning substance, right? That can, produce a yield or produce earnings value. I think one of the interesting things to me is that, and you could point to a lot of the original catalysts for this recent gold surge, whether it's inflation concerns, geopolitical risks, diversification, but one of the biggest drivers, was or has been central bank buying. And that trend really picked up in 2022, 2023, and 2024, where you saw a lot of that central bank buying as the central banks rebalanced their reserves and or reduced reliance on the US dollar. But this year, we're starting to see a shift. Central banks are still buying, sure, but the pace seems to have slowed compared to the last 3 years. And in their place, retail investors have stepped in. And what we're seeing is ETF flows and physical demand from individual investors have ramped up sharply. And to me, when I see that the original catalyst, when that buying support is starting to come down, and then the retail investors starting to step up. To me, I look at that and I say that kind of does feel like the rally now, right now, is being fueled more by the crowd than by the institutions, which to me suggests that maybe this is a lot of speculation being priced in, and that's not to say that gold has to go to zero tomorrow. It won't go to zero tomorrow, but you know, it, but and it could continue to go up. But I would personally be careful.
I agree. I mean, I agree. I just think that in certain parts of the world, gold has value, particularly if you live in a country that the economy is depressed, or the government is unstable, where the military might control things, or if there's a coup or stuff like that. I mean, you can trade gold for your life and food. What we're seeing in the market here is just a whole other phenomenon, and it's the way markets behave. At times, the animal spirits intervene, and it has moves. As Austin said, you could have made a bit of a fundamental case maybe 6 to 12 months ago with worries about tariffs and central banks kind of repositioning their balance sheets because of a lot of people owning very leveraged societies and things like that, budget deficits and that sort of thing. But it's different now. It's just up too high. If we had bought it, honestly, if we had bought that 12 months ago, we would have been out of it 6 months ago. So it's
Right.
like, lucky you would made some money and move on.
Right. Right. How about the government shutdown? That seems to be big in the headlines right now. We're entering the fifth week, I believe. I think that maths. Yeah. Do you think the shutdown has a big impact on the markets?
Historically, it hasn't, and it hasn't here. I mean, we were joking around the office that if the government didn't open, that the Dow would be over 50,000 by Thanksgiving. But the bad part of it is, as a citizen, it's a shame that we go through this all the time, and it really you would hope that our elected servants would do their job, and we don't know at this point what economic effect it is having. I would think would have to. You've got air traffic controllers seeking other jobs so they can pay their way. I mean, it's just people not getting paid, people that need food assistance, all sorts of things like that. It's just bad. Forget the stock market. It's bad.
Right. I think it's worth noting that the 2018-2019 shutdown was a pretty long shutdown as well. It lasted so long that similar to now, TSA agents were finding new jobs or calling in sick. National parks were overflowing with trash, and economists estimated it shaved about 11 billion off of GDP. Though the US never went into recession and most of that 11 billion was recovered once the government reopened. So I think to your point, we should focus on the shutdown more as a, what's right for our society and our people. Um, and maybe discount it a bit, in terms of what it means to the stock market. The stock market's a very powerful beast. Certainly something to keep an eye on, but something that I don't think we're putting much emphasis on in terms of future stock market returns at this point because the government's going to open again, right? People are going to get paid. That money's going to start moving. But for now, unfortunately, we are where we are.
I can tell you if the stock market went into a correction, they would open up the government.
Right? Maybe that's it. Put the power in the hands of the
Maybe
people.
what we need. That's not what the rooting's for.
No, not rooting for that at all. And I guess it's worth noticing. I don't know what you do with this because it's a small sample set, but if you look back over the last 30 years, the U.S. has actually been less likely to be in a recession when the government is shut down than when it's open.
Yeah, for sure.
So we covered a lot of topics there. I think we brought you to 50 minutes, so you get your credits. Please remember to reach out if you have any questions. You could reach out to your Withum CPA or reach out directly to us through the website. Either way, your CPA will be able to find us. You'll be able to find us through the website. Please take a look at our podcast. Remember to like and follow, and thank you for your time.